A very good morning to you. Thank you for joining us on the program. I am BC Adebayo. Brent crude is trading around $50 per barrel this morning due to a surprise gain in crude oil inventories in the United States, and as investors continue to worry about demand for fuel being squeezed amid tighter lockdowns in Europe to counter the coronavirus pandemic. Brent crude futures were trading around $50.68 a barrel in early trade, while U.S. WTI futures were seen around $47.56 a barrel. Data from the American Petroleum Institute showed crude inventories swelled by 2 million barrels in the week to December the 11th to about 495 million barrels. Analysts had expected a draw of 1.9 million barrels, according to a poll carried out by Reuters. Meantime, the IEA has revised down its estimates for oil demand this year by 50,000 barrels per day and for next year by 170,000 barrels per day, citing scarce jet fuel use as fewer people travel by air. And back home, the Nigerian Communications Commission has directed telecommunications operators in the country to block all the numbers of their subscribers that do not provide their registered national identification numbers within 2 weeks. The decision was announced in a tweet by the personal assistant to President Muhammadu Buhari on new media, Bashir Ahmed, on Tuesday. The resolution is coming less than a week when the NCC directed all telecom service providers to suspend the sale and registration of new SIM cards across the country. On Tuesday, the National Bureau of Statistics released the inflation data for November, showing a 15th consecutive rise to 14.89%. The World Bank also formally approved the $1.5 billion loan for Nigeria. Well, joining me now to give a market perspective to all of this is the acting MD of Quarters Asset Management, Mr. Gbolan Aina. Good morning and thank you for joining us on the program. Now, let's begin with the inflation numbers. Was this in line with your estimate?
Good morning, BC. Thanks for having me. Like you rightly said, the inflation figures came out and it was higher by 66 basis points to 14.89% from what we saw the prior months. Really was a bit shy from our own estimates. We had thought it was going to close about 14.95%, but really was still much in line in terms of the fact that inflation has been on a northward trajectory. If you look at the inflation figures that came out, it was more food inflation. Food inflation started by 92 basis points to 18.3% on a year-on-year basis. Interestingly, that's the highest we've seen since January 2018. And we believe that the sustained pressure in food basket really due to the underwhelming harvest season. Also, a lot of security challenges in the northeast or the food producing region of the country. And of course, we can't also discount the lingering effects of the border closure, which has contributed to the supply gap. So we think that this has continued to put pressure on food prices. And interestingly, for core inflation tapered a bit for the month. It came down by 9 basis points to 11.05% year on year. And that is a divergence from the uptick we saw in the prior months. Housing, water, electricity, and other gases and fuel, though they surged upwards, but by and large, core inflation came down. In terms of what we expect for inflation in the month of December, December is the festive period, so we still expect to see a lot of demand in the festive period. And I did mention that harvest has been underwhelming. It's not been as much as we've seen in recent times. So there's still, that pressure is still going to be sustained as we go into the month of December. So inflation for the month of December is still expected to at least move upwards when the figures are released.
So what sort of reaction are we likely to get from the equity and the bond market? Or is it going to be business as usual?
Okay, usually when inflation goes up, it signals something really that things are generally going up. And if things are going up, means purchasing power reduces for consumer. For people that in the manufacturing sector, for instance, input prices go up. And that means some of those prices can either be passed to the consumer. Usually when there's so high inflation as well, the monetary authority usually respond by hiking rates. But because we are in a peculiar situation, this is a COVID period, the stance has been more of a dovish stance rather than a contractionary stance. So we've seen them reduce rates. So we don't expect them to hike rates to be able to tackle inflation. More so, the inflation has been more of cost push and not demand push. So really, hiking rates might not really solve that inflationary pressure. So Do we expect an impact in the equity market? No, from these figures. What has driven the equity market has been the huge liquidity profile we've had in the system and the unattractive yield in fixed income environments. So the equity market is still going to go up, but not because of these inflation figures. And usually when there's high inflation as well, I did mention that monetary authorities usually hike rates. We don't expect them to hike rates. So we don't expect the fixed income market to react to this inflation figure. So it's more or less going to be like status quo. Other factors are going to drive performance and not the inflation numbers that we've seen.
Now, you did mention earlier that we might see, of course, a continuous spike in inflation extend to the month of December. But how long do you think that the inflation will continue to rise? Is this trend likely to continue into the new year, 2021?
Yes, it will continue to the new year, but at some point, we're going to see base effect kick in. And because you have a high base in 2020, so by sometime in 2020, we're going to see that reversal. Also, we also expect the monetary authority to change their approach next year as we exit recession. We expect they're going to exit recession sometime in Q1 or Q2 next year, and we expect them to change from a dovish stance to more like a contractionary stance, and they might begin to hike rates, might begin to see rates go up next year. We want to tackle inflation, and also to ensure that the unattractive yields in the environment somewhat becomes attractive. So we don't expect to linger for long. When the beginning part of the year, we still expect the inflation rate to go up. But as we go towards the end of the year, we expect base effect to kick in, and we expect rates to begin to taper sometime next year.
But in view of the rise in inflation now, how should investors begin to plan their finances for 2021?
I think it's a very good question. I think for 2020, there have been a lot of unexpected. There are so many things that people didn't plan, and even people that planned, it was really against their plan. And what I would say is that while planning is good, also good to have various scenarios. So while you have a financial plan, it's always good to have a different scenario planning. So you have your best case, maybe your worst case, and your base case. And based on whatever happens, you're able to respond appropriately. I think that's one of the key lessons from COVID-19. And I think finance is very key because finances cuts across different segments. It affects everybody. It affects you as a broadcaster, it affects me in what I do, it affects parents and all that. So planning your finances adequately is very important. I'd like to mention that there are so many misconceptions about financial planning. Something that is just for the rich, or it's just the same as investment. Something that is the same as tax planning or insurance planning. Well, tax planning, insurance planning are elements of the financial plan, but really that's not all to financial plan. And in 2021, initially it might be a bit rough, but I guess if people are able to plan their finances very well, things are going to organ well for a lot of people. Interestingly, for some people, this year wasn't as bad as for some other people. Why? Because we're able to plan actively or plan effectively. And I would say that in coming up with your financial plan, you have to do like a comprehensive evaluation of your current situation and also your future circumstance as well. You have to gather information in terms of your revenue, in terms of your cash flow, in terms of your investment as well. You need to be able to evaluate your circumstances as well. And based on that, you're able to institute a financial plan. But what I would say is that people should take their investment very serious as they enter 2021. As much as possible, try to get investment that can give you that inflation edge, that inflation benefit. Some people have been investing in the equity market, which is good, but I'll say that invest in justifiable, viable stocks. Invest through a proportional manager as well, because sometimes tides can change. Also, for people that require liquidity as well, you might be able to take some position in money market instruments or money market mutual funds as well to help you plan that liquidity, because it's always good for you to have that liquidity, to have that emergency fund. For this year, for instance, a lot of people lost their jobs, and I think some people were able to probably go through that job loss because they had that emergency fund. So emergency fund is very critical in your 2021 financial plan. Having investment that more or less speaks to your objective is very important. And also tax planning as well is critical in your financial plan as well. Like I did say, it's good to speak to a professional. I think one thing I also mentioned is to have a health plan. They say health is wealth. And in your financial plan, I think it's always good to also have that health plan. Go for a checkup early in the year, and as much as possible, do a periodic checkup as well. So having all this in context, like this said, having various scenarios will help you also be able to adjust perfectly for 2021.
Now, let's get your views on the $1.5 billion World Bank loan now. How do you think that loan will benefit Nigeria?
So great question. So the World Bank loan is usually developmental in nature, and this is even quite different from the 1.5 billion budget support loan. And according to the World Bank, this is meant to help social transfer, basic services, and really to provide grants to poor and vulnerable households. So over time, World Bank has always supported Nigeria with some of these kind of loans. And in the work of the COVID-19 as well, some of these loans were given to Nigeria. So I think it's a step in the right direction. It's more or less to help the vulnerable citizens, to help the poor citizens. And I think it's also going to help our external reserve a great deal. So 1.5 billion coming to our external reserve is going to more or less reduce the pressure we've seen in the FX in recent time. So I think it's welcoming. I think it's good. Like I did mention, this is quite different from the 1.5 billion budget support loan. I did mention that is going to be contingent on some certain things. One is on having a unified exchange rate, deregulation in the downstream sector, and also having a reflective tariff. We've seen the federal government done a bit of deregulation in the downstream sector, and also the energy tariff as well. But they are currently working on the unifying the exchange rate. So hopefully that might come through as well. And I did mention it's going to give a lot of support to the external reserve.
Now, part of the criteria is the regulation of the downstream sector, which has seen some level of kickbacks from civil society groups and even organized labor. But does the adjustment of 5 naira reflect the fact that we are yet to see a full deregulation of the oil sector?
Yes, absolutely. So if there's full devaluation, that means everything is going to be based on market forces, demand and supply, and really no government intervention. And Nigeria is currently in a peculiar situation. And while they might want to do a full deregulation, I expect to see some kickbacks by organized labor union. And also, this is like a challenging period as well. People are poorer at the moment. So just to institute that food deregulation might mean that prices might go up, and I guess that's where the kickback is. So I think it's going to be done gradually. So I would say it's not a food devaluation because there's still a bit of government intervention. People really expect that really when the market is in contango that prices are not adjusted like this. But I expect it to be done gradually, like I did said, because of the peculiar situation we're in. This is COVID-19, and really income has not really gone up. Income has reduced. People have lost jobs, and also increasing the price of PMS means that people are poorer. People cannot really afford certain things that they could. And I guess also because of the economic importance of petroleum as well, it costs across almost everything we do. So increasing price of petroleum is increasing prices of almost everything indirectly.
Now, this loan means that our total public debt profile has increased beyond 31 trillion naira. What impact will this have on our GDP per capita? Okay, so I think the major issue is not usually the size of the debts and not just the GDP per capita. So I think what would be good to note is that the debt to GDP ratio for Nigeria is currently about 30%, which seems not to be too bad, but that doesn't say the whole picture. By the time we start looking at our debt to revenue ratio, which is above 60%, I think that's where it becomes alarming, because it means that from every revenue we earn, about 60% is used to service our debt. That means what can be put into productive use or into capex is quite minimal. So in terms of debt to service ratio, that is high. I think that's where we want to watch it. Debt, you did mention about GDP per capita. Nigeria is currently about $2,000, which is not too good. So the GDP per capita looks at the GDP of every nation divided by the population of every nation. And Nigeria ranks about 138. About maybe 180 countries are profiled by the IMF and the World Bank. For countries that are quite prosperous, that number is in excess of $100,000. So it means that every individual is just present about $2,000 on an annual basis, which is quite ridiculous. But if the loan that is coming can be put to productive use, I think it's going to be able to bring out some people from poverty. Like I said, it's meant to help some social transfer as well. So if it's put to productive use, I don't think is a bad thing. And the good thing about IMF loans, they are developmental loans. They are not as stringent as some other loans.
while there are terms and conditions attached to it, in terms of the rate, is not as high as some other loans that you see. So it's quite convenient. And over time, Nigeria has repaid most of the IMF loan they've taken in the past. So it's meant to help the vulnerable, it's meant to help the citizen, and it's meant to more or less support growth and pull Nigeria out of the current recession that we are in. So I think it's a positive if I'm to answer that question.
Now, talking about spurring growth, now, when you put all of this together, how much will this actually pose to our economic recovery, bearing in mind the steep growth projections for 2021?
So I think is so these numbers are not 1.5 billion is something, but of course it's not going to solve Nigeria's economic issues. But like I just said, it's going to pull some people out of poverty if it's well administered. So it's meant to be some social transfer. So some people are getting some cash. And really when there is money that is being put in the economy, what happens is that it fuels the economy. There's a lot of transaction that is going on. There's a lot of activity that is going on. There's a lot of productivity that is going on. And that also helps the GDP of the nation. So I think it's good. Of course, it's not going to solve our problem. Those problems were not created in a day or in months. Some of the problems we have, they've been there for years. Some of it because the economy is not yet well diversified in terms of revenue. So this wouldn't solve everything, but it's going to pull some people out of poverty, and it's going to be able to, one, facilitate the recovery and also enhance capabilities of MSMEs in the country. So I think it's good.
So should we expect the CBN to react to the call by the World Bank for a more flexible exchange rate?
Yeah, so the CBN, they've adjusted twice this year as well. So with what we've seen in the parallel market in the recent time as well, so there have been some appreciation in the Naira. Naira strengthening against the dollar as well. And so we've seen a lot of intervention from the CBN in this regard as well. And we expect the Naira to also strengthen a bit more with this 1.5 billion that is coming on board, which means the external reserve is going to at least get a bit of shock absorber. I don't expect all the problems to be solved in one day. So I expect it's going to be gradual, but I expect the CBN to gradually begin to see that unification or that flexibility that the IMF requested.
All right, just before you go, Balao, let me get your thoughts on your expectations from today's Treasury bills auction and, of course, the bond auction as well. What are your expectations from that?
Okay, great. So there was an NTB auction last week, and we saw a bit of change in narrative for the 1 year. It closed at 3.2. Market participant I thought it was going to close at about 0.08, but it did close higher. For the 91-day close at 0.01, while the 1-2-day close at 0.6%. And market has been bearish since then. A lot of people selling off their position to be able to book at higher yields. For today's auction, we expect to see similar performance. While we don't expect the 1 year to close that high, we expect it to close between 0.5 and maybe 1%. For the 1-2-day, we expect to close between 0.02 and 0.04%. And for the 91 days, we expect to close at current levels, which is about 0.01%. We still expect yields in the NTB auction to really pretty much be not so attractive. And there's also a bond auction today, which is the last of the year. The DMO is going to be raising about 60 billion. It was meant to be 80 billion initially in 15-year and 25-year bond as well. We expect to close slightly higher than where it closed last auction. From last NTB auction, market has been bearish. There's been a lot of sell-off, people trying to position for higher yields. So we expect it to close higher than where it closed at the last auction, but really nothing so significant.
All right, I'd like to thank you, Acting MD at Codros Asset Management Limited, Balao Aino, to thank you a lot and do enjoy the rest of your day.
Thank you.
We'll be back in just a moment. Please stay with us. Welcome back. Now, anxiety is mounting over entities and companies that emerge winners of the 2020 bid round for the 57 marginal fields in the country, just as the Department of Petroleum Resources continues to maintain that the process is ongoing. In an exclusive interview with Channel's television energy correspondent Olu Phillips, the director and CEO of the DPR, Mr. Sariki Awalu, says it's difficult to announce a winner. According to him, what's more important is to see the field come to production than emphasis on who or which entity got the license. Let's listen to him.
Interesting to let Nigerians know. Are we done with the marginal field rounds that started, that you are supervising under your ministry? Are we done with it?
You know, marginal bid round essentially is a process, an ongoing process. And for this, just as we specify, it's specifically stated in the DPR guidelines for marginal field bid round. For 2020, there are guides in which people apply, do everything, and we're in the process. And the process is that we receive application, we qualify companies that are ready to apply, and they applied, giving all necessary information, and we review those applications. And we didn't stop there, not technical. We also go deeper to really know more about the companies and the people behind the companies. And those companies, we do in-depth due diligence to know the ultimate beneficiaries in the companies. That took time. And it gets into financial due diligence in which relevant government agencies were asked to help. And we didn't stop there. Relevant security agencies to clear the companies or individual. Then we factor that into analysis of either the technical bid submission and the commercial bid submission and the offer for the signature bonus. And we process. And we look at it in a way that our aim for the marginal field is to see how we can bring those fields to production. These are fields that are discovered but abandoned for more than 10 years. So Nigerians are...
Is it 57?
Yes.
57.
So, you know, Nigerians are excited because this is something that did not happen in the last 18 years. It only happened in 2003. So you expect the appetite of that. But what we are expecting Nigerians to be more excited is the bigger bid round, the block bid round, where the thing is. We've already opened up new frontiers, the Home Basin, Benue Basin, Anambra Basin, Bidda Basin, Sokoto Basin. And already in this basin, there are discoveries in other countries. And we know the potential is there. And we test waters. This marginal field gives us ability to know that there are companies in Nigeria that are competent, have enough capital on their own to really go into exploration and production. That is one gain. Second, we now understand that we have capacity as Nigerian to have people that do not really need any kind of a white man support, if I can use that word in court, to really explore oil and gas. And also, it gives us ability to know that there are companies that can be assisted as the others were assisted to come on board, because currently there are Nigerian companies that are quoted in several, international stock exchange, courtesy of this similar program. So, where we are now,
because it's
where we are now, we are yet to round up. And what we are doing is we contact all through. We have never published, these are the number of companies that applied. These are the number of companies that qualified. These are the number of companies that applied. We have never published that. So we don't expect to publish, these are the number of companies that are successful. What we do, at every stage, if the company passed that stage, we now write to the company. Say, this is it, this is what, because it's a process.
Have you written to some people?
Well, we written to some people that, you are qualified, apply.
Okay.
And we are in the process of looking at that application based on the explanation I give you. And some companies in Nigeria that were invited by other agencies in relation to what we do.
Yeah, because
so yes, so you see, people, they are thinking that, oh, we just finished, we published the list and say, oh, we have finished marginal field bid round. Remember, once we finish, even if you are successful, we will now use your FDP, the field development plan. That is when the real work starts. That is when the real news will be created. When will you bring this field to production? And we follow you through, because this is our normal work. There is a dedicated department in DPR, lease administration. So it's the lease administration that is doing the process. But because, oh, this is something exclusively for Nigerians, so they are excited. And I can tell you, all the companies that apply exclusively, they are exclusive Nigerians, and we're excited that people are really ready to stimulate the economy with their money. And as the process is ongoing, because it is not a news that some companies were invited by some agencies in relation to what we do. So if you look at it, every agency that has to do with anything with all the companies, we have to make sure we clear everything before we now write to the company that, well, this is it, and this is what we see. And we believe as a normal, that is why whenever I was asked, when do you finish? Of course we can't finish. There's no time to say that when do we now bring the field to production? That is the key.
Are you putting a target for yourself to that? Because
yes.
This can be endless.
We put the production. If you remember when we launched it, we said this field must produce within 24 months. And I mean it.
Of completing that
initial
process?
Everything I said, the field, we need to bring them to production in 24 months. People say it's too aggressive. I say no. Look at it. In 16 weeks, we're able to be where we are. We finished the application process. We processed all the applicants. Some were rejected in the process. Oh, now people, agencies relevant, they were doing their work, financial due diligence, in-depth due diligence on people. Oh, okay, we are trying to now get the farm out agreement with the OML holders. All these are work. And you can't, even if you say you finish, you sign letter, take your award letter. You have to go to the OML holder to say, I want to sign farm out agreement. I want to delineate. DPR is already doing that. And if you didn't do that, you didn't do nothing. Award or no award. There has to be a farm out agreement. So the owner of the OML had to farm out, you have to farm in. And there is an agreement. We are trying to get that done. So it's a work that is ongoing. And in the process, some they will say, no, I can't agree with this farm out agreement, I'm out.
Even though they may have.
Even though they may, yes. So that is why it is not possible for you to say, I finished, this is the winner. Because somebody will say, no, I don't agree with this condition. So me, I'm out. Another person will say, I'm in.
That one-on-one conversation between the director and the CEO of the DPR, Mr. Sariki Awalu, and our energy correspondent, Olu Phillips, forms the basis of our next conversation. And joining me now to discuss the issues surrounding the marginal oil field bid round is an oil and gas consultant and the founder of Septon Frost, Olayemi Ayanechi. Good morning, and thank you for joining us on the program. Of course, I'm sure that you've watched that extensive interview with the DPR boss. You have advised on some of the largest and the most significant oil and gas and energy bid rounds. What comes to mind listening to the DPR boss explanation about the processes for the 57 marginal oil fields?
Well, thank you very much for having me. Having listened to the DPR director, I will just talk basically from the perspective of law and from the perspective of experience. Now, the Marginal Field Award is actually the purview of the president of the country. So if you look at the Petroleum Act, it says the president has the right to approve. And it also says that the president may decline to grant a marginal fee to anybody who does not meet the criteria. So there's a particular, there's a subjective test. Is this person, acceptable to the federal government? And the way that law is worded, actually, the president need not give you any reason why it's not acceptable. The president need not justify his decision. So whether that is the right kind of law for the environment we live in today is another matter entirely. It has that discretion. Marginal feels that largely discretionary awards, even when they are put to bid, just because the president need not give a reason. Now, when you look at the guidelines, right, the guidelines state the criteria for award, the criteria, how the process will run. And like the DPR director said, there is really nothing in the guidelines that compels them to make a public announcement. The guideline simply says that they would communicate with the successful bidder and let the successful bidder know that it has won. Now, from the perspective of being a Nigerian, my views may vary. I may talk about transparency, but if I were to talk as a lawyer, I would then say, you know what, when the government issues a request for you to express your interest, they're effectively saying, you know what, they invite you, there is an invitation. And when you accept that invitation and you make an offer, they are entitled to act in accordance with the terms of the offer they have made to you. So in that score, is the DPR director right? I will speak based on the guidelines. And there was nothing in the guidelines that compelled them to either give a reason or to notify the public. As long as they notified people that are successful every step of the way, they have effectively complied with the terms of the guideline.
So how would you weigh the level of transparency adopted in the entire process, looking at the possibility of favoring some certain companies?
Well, you know, like I said, you know, transparency when you come to marginal field award, I think that's something we'll keep pushing. And hopefully when the PIB is passed, things will improve. But as I said, it's purely discretionary. The law just gives the president the right. And it says that, you know what, they may not grant that approval to anyone that they do not find suitable. So how do you justify transparency in a law that gives you carte blanche, more or less? Says you can just decide that this person is not suitable. The law does not compel you to give a reason. And to the extent that you are not required to give a reason, transparency itself is really an ideal that we're striving to achieve. So there's nothing that requires transparency. They may decide to be transparent based on where the world is going, but from a legal perspective, it's purely discretionary, actually.
Now, part of what the DPR boss also talked about was that the eventual winners of the bid round will be given 2 years prospecting license. What's the likelihood of a return on investment? Of course, when you look at the fact that these oil fields have been abandoned for more than 10 years.
Well, I'm not sure that's what, I mean, my understanding of what he said was that the fields must start producing. They do not reach the end of life, right? And if you look at the guidelines actually gives them 60 months, that's 5 years, to show that they have done, that they have walked that block, right, diligently. Now, historically, when you look at what happened in 2003, a lot of fields were awarded, quite a lot of them haven't been developed. And I would think if the objective of the government is to increase participation of the indigenous participants, if the objective is also increase the tax and other revenues that come to government, the government has an incentive to make sure that these blocks are worked and they are produced in a judicious manner. So I do not believe that they say if you do not, that you must, that the thing comes to an end after 2 years. That's not my understanding of the guidelines. They have 5 years. But you must start producing in 2 years. And then if you actually do it, you can work that field diligently. The guidelines also say that you'll be given another term in line with the law. So you actually have more than 2 years for a field that is actually producing and working.
But when you look at the number of bids submitted now, is there any likelihood of mergers between prospective companies?
Well, the guidelines also allows that. So people are allowed to be together and people may be merged. Now, How that would work in practice, we would have to find out, because I remember very well in 2005, where they had the local content vehicles and they were kind of imposed on winners of blocks. It didn't work out very well, because it's really difficult to put that much money into a project where you don't even know, you don't understand your partners. So I reckon, because of the sheer number of applications and the sheer number of people that participated. And as you heard the director, a lot of Nigerians companies now, they have the competence actually to develop those skills without necessarily bringing in the foreign partners. And, if you want to assure some kind of equity amongst people, and you want to ensure that, there's a balance of award, you may have to merge. It then depends on whether people that are merged decide to go with it. Like you said, some people would decline. I mean, I know a couple of people that would rather not, really, if they don't like the identity of the people they've been merged with. So ultimately, it will depend on who they've been merged with. It will depend on their risk appetite. It will depend on what they choose to do. And until that farm out agreement is signed, you can't really say that the process has been completed.
All right, we'd like to thank you, oil and gas consultant and founder of Sefton Frost, Olayemi Ayoneji. Thank you for sharing some of your time with us this morning.
Thank you. Thank you very much. Bye-bye.
All right, let's talk about Tuesday's trading at the Nigerian Stock Exchange, and Edidiong Iwang will be taking us through the numbers. Good morning, Eddie. So it appears the bulls are finally here to stay at the market. Another 1.1% increase on Tuesday. How did all of that come up?
Good morning, BC. You're right. Well, investors went about cherry picking and bargain hunting on cement and banking stocks. So that was what lifted the market yesterday. We're up, just like you said, 1.10% at 35,225.22 points, while the equity cap was at 18.410 trillion naira. We saw about 246.24 million units worth 2.94 billion naira traded in 4,354 deals. Now, the sector chart was mostly positive, apart from the consumer goods sector, which was down 0.09%, and that was due to declines on international breweries, but all the other sectors we track gained. Let's talk to Abdurrashid Momo, a stockbroker. Good morning, Mr. Momo. Thank you for joining us on the program. Hello, Momo. Hello, Mr. Momo. If you can hear me, we've seen the markets, we've seen gains in the market from the beginning of the week and also yesterday. Do you think this is the beginning of the much-awaited rally? I think we have lost Mr. Momo there, but the banking sector was up 2.04%. We saw Zenith Bank posting gains, FBN Holdings was up, GT Bank and Access Bank were up, Industrial Goods was up 2.40%. Of course, that was due to the gains on Dangote Cement and WAPCO. Insurance sector was up 3.50%. We saw a lot of gains from Lasaco, AXA Mansard, ICO Insurance and Cornerstone Assurance, and the oil and gas sector was also up 0.42%. The unlisted securities market was, negative yesterday, was down 0.85% at 725.85 points. While the market cap was at 539.52 billion naira. Here, Mr. Momo is back with us on the show. Good morning, Mr. Momo. Do you think the gains we're seeing in the market is the beginning of the much-awaited rally?
Okay, as I said earlier, there are three parameters which we look at in TLW stockbrokers. That's the moving averages. First of all, we know there was a 35,814 level before market started dropping, and since then market has been trending within that 35,800 to about 34,000 points, 34,400. So market has been ranged back within that period until we see a breakout from that level that we can say this is the beginning of a new bull market. Mind you, we are in the December rally, which we actually call the Santa Claus rally, stroke window dressing period, where portfolio managers try to window dress, their portfolio at the end of the year. All things being equal, the outlook is still bullish, but from the three parameters which we have, the market has done two. The third one will decide where the market is going to go. If we cross over, as I said, the market, this will be the beginning of a long bull rally into next year. If we don't, then the market will continue to be range bound. We need to break 35,814 levels first before we decide whether this is the beginning of a rally or not. What I'll say is that for traders, they buy in weakness and sell in strength. And for investors that are waiting, they are long-term players, it's still a good time to hold on because of dividend payouts from the quoted companies. At least from the Q3 we've seen, they're all doing well. Most of them are doing well. So that's what I have to say.
All right, Mr. Momo, thank you for your input on the program. Abdurrashid Momo is a stockbroker. Well, BC, you heard it, buying weakness and selling strength.
Absolutely, Eddie Young. Of course, we'll be back to you in just a moment for the debt and currencies market, but that will be after we check out the latest UK inflation numbers. Do stay with us. The latest news coming from the UK this morning is the inflation data for November showing a dramatic fall to 0.3%. Juliana Olayinka will be telling us more about this. Good morning, Juliana. Can you unpack the inflation data for us? What's responsible for the drastic decline?
Well, economists say Black Friday in November appears to have really dragged down prices as you can imagine, lots of retailers are desperate to get some of their stock off the shelves. I think according to the latest data, the prices for footwear and clothing at the moment is 3.6% lower than it was this time last year. But this dramatic fall, as you say, from 0.7% in October to 0.3% in November, not really great for the British economy, especially on the first day of the Bank of England MPC meeting. They'll be meeting over the next 2 days. We're expecting a statement from them tomorrow about whether or not there will be any economic stimulus. And the Bank of England have set a target rate of inflation in this country at 2%. So 0.3% is way off of that. It was offset by a rise in prices in toys, games, as people have been locked down. Lots of people have been spending on those goods. But yes, as you said, 0.3%, not great, but it does boost the purchasing power of consumers, which is important, especially as we're just round the corner from Christmas, Bissy.
And some not so good news for rail users. I know that you're one of them, Juliana, but the rail minister, Chris Hitton-Harris, says that you guys will be paying more next year with prices increasing by 1.6% in January. What's the reason for this?
Well, it's 2.6%, and typically, Bissy, we are used to seeing this. It's about this time of the year, usually just after Christmas, that anybody that uses the rail does see an increase. But this is the first time in 8 years, as you said, that it has been above inflation, and a lot of opposition leaders are not happy about it, especially union bosses that work and support people that use the rail. It's been a long-running, heated debate here in the UK about the prices of getting outside of London to across certain parts of the country. A lot of travellers, commuters say that it's not on time, that it's dirty, it's unclean, and it's unkept. But particularly this time of the year, it has been difficult because the taxpayer, funded obviously through the government, have been paying for the rails, and because of the work from home sentiment which the government has been pushing to people, not many people have been using it, and it costs about £30 million a day to run these trains. And then what's usually keeping them afloat is the £10 billion a year that the rail workers get to keep the trains going. Obviously, in 2020, they haven't seen this money. So a lot of rail union bosses are asking the government to stop these unscrupulous, as they call them, rail passenger fare rises. And they should look at the ways that this can be reformed going into 2021, because so many people have changed their working habits. Usually people buy seasonal tickets or monthly tickets, but so many people are working from home. Is that now a redundant kind of space? days. I suppose for some rail users, one of the good things is that this will not kick in on January the 1st, because as I said, it's traditional every year in this country that you do see a rail rise at the end of the year. But because of what's happened with COVID, this has been extended or pushed back until March. But again, lots of people are not happy. They just think, using the rail is completely unaffordable. And now because of the change in working patterns, people are just not buying those seasonal tickets.
All right, Juliana. Now, the toughest tier of coronavirus restrictions have come into effect today. What's the situation like?
Well, the situation is lots of pubs, bars, hotels, restaurants have been closed. I, for one, definitely got a few cancellation emails yesterday, which I'm not too happy about. But of course, it's all about keeping people safe, which is the most important thing. So now London and lots of areas in the southeast are under these tier 3 restrictions. So it definitely kind of feels like a lockdown. If you are working, you are still working, but they are asking people to stay within their region. You can obviously only get takeaway from these restaurants. A massive blow to tens of thousands of pubs, who did think that they were going to be able to claw back some of the lost revenue during both lockdowns just before the run up to Christmas. That, of course, has been completely cut short. One of the main talking points of discussion in the British media today is Christmas. We do know that, controversially, a couple of weeks ago, Prime Minister Boris Johnson did declare that you would have a 5-day break. Now, there was a joint article written by the most senior professional health practitioners in the country. This is the first time, well, the second time in 100 years that they've ever done this joint statement together, and they are asking the government to stop this loosening of restrictions, that perhaps there could be up to 19,000 people in intensive care by the end of the year. And that 19,000 is as much as we had in intensive care at the peak in April. So there's lots of discussions right about now. Michael Gove, a senior cabinet minister, is going to be speaking to the first ministers of the devolved administrations. And, it's likely that there will be another U-turn and the government will decide that they are going to scrap this 5 days of Christmas relaxation. Boris Johnson still wants to do it, but the scientists are just not backing it. And some people just don't think it's worth it when they've got Easter and several other holidays coming up in the new year.
All right, Juliana, thank you. We'll see you again in the afternoon. All right, let's bring back Eddie Dion to review the debt and currencies market. Over to you, Eddie.
Thank you, Bisil. The bond market has been on the rise. Yields in this segment of the market have been on the rise lately. But let's talk to Chama Udu, who will give us more insight into that. Good morning, Chama. Thank you for joining us on the program.
Good morning, Eddie. Thank you for having me.
Well, we've seen yields, rising continuously in the bond market. Is it too soon for investors to get their hopes up, or, are we likely to see this continue for the meantime?
Well, Eddie, what we saw last week and coming in this week was profit taking, basically. And the year has come to an end, and we're seeing investors trying to take profit right now. However, it's not out of place to say that yields might be trending up right now. Inflation came out at 14.9. This is the highest we've seen in a very long time. And there's an auction today. There are two auctions today, actually, where 67 billion is an offer at both auctions, 60 billion on the bond across 2 tenors, and 7 billion for the NCB auction across 3 tenors. With the inflation rate at 14.9 and the liquidity in the market, we expect that rates in the NCB space will maintain, or at least will maintain or moderate, and then the bond rates will continue to trade at the range of 6 and 7%, where we see it currently.
With the low yield environment, especially in the Treasury bill space, how long do you think investors will continue to participate in that segment of the market?
Well, the system opened over 600 billion up, right? And like you said, there's a low yield environment and there's a lot of interest in that space. There isn't a lot of assets out there to invest in. So you see a lot of grabbing by investors. Investors are looking for anywhere and any way to put in their funds in the short tenured assets in anticipation of the reversal of rates. So they try to invest at the T-bill space so that they can quickly sell or quickly come out of those tenors as yields rise in the market.
All right, Choma, thank you for your input on the program. Choma Udu is a fixed income dealer at GT Bank. We'll have to leave it there on the markets for today, BC. Over to you.
All right, Adijong, thank you. Of course, we'll do this again tomorrow. And that's where we wrap up today's program. Thank you for watching. I am BC Adebayo.